If recent headlines about China's stock market surge have you curious, you are in the right place.
It's something that we've been hoping for, expecting to see, and it's really coming through.
An upward trend since September 2024, when China's stock market experienced its best day in 16 years after the launch of government stimulus package. Until now, the Shanghai Composite Index has hit 4,000 points and the Shenzhen Component Index hit 14,000 points. This isn't just a simple bounce.
If you want to invest in the future, if you want to invest in innovation, the Chinese equity market is definitely a good way to play that.
UBS predicts a 10% growth on China equities earnings per share in 2026.
We are positive, particularly in the first half.
As for the new hotspot emerged so far this year,
AI is still going to be a very big thing. There will be sector rotations.
Chinese AI firms and chip makers have started flocking onto the stock market.
AI is going to be the dominant thing still for global equities, and the best ways to play that is going to be through US and China.
Will this wave of stock price rally continue in 2026, and how? I sat down with James Wang, head of China Equity Strategy Research at UBS. Mr. Wang, great to have you with us on Shanghai Eye.
Thank you.
UBS recently set a 2026 year-end target of 30,000 for Shenzhen Index and 100 for MSCI China. What do you think is the primary investment narrative supporting these targets, and what is the biggest risk to achieving them?
The way we think about a target is we think there's sort of 14-15% upside for the full year, and we get it a couple of ways. So we think there's going to be EPS growth of up to 10% for the full year, and maybe a bit of valuation uplifts to say 4 to 5%. If you look at the average valuation for Chinese equities, particularly MSCI China, for example, we're still trading around historical average. But versus global markets, MSCI Global or EM, we're still trading close to one standard deviation below historical average. So with US cutting interest rates most likely this year, we think there's still valuation upside for Chinese equity. The second part is on EPS. So we've got 10% EPS growth, and we break it down into a couple of parts. So we've got revenue growth of 5% for the full year, and that's broadly consistent with our nominal GDP growth of 4 to 5%. So it's consistent with what we've seen historically. And the second part is going to come from margin expansion. So we've got 4% margin expansion. One part of that we have seen, for example, depreciation peak out for listed companies. And what that represents is because CapEx for listed companies have been declining. So if I look at listed companies, since 2024, CapEx have been declining to the extent of up to 10% for listed companies. It's recovered a little bit, but still on a declining trend in 2025. So for this year, 26, that declining CapEx should result in lower depreciation. So that provides a bit of an EPS boost to the extent of 1 to 2 percentage points. And the second part to that margin expansion is going to come from anti-involution. So we have seen different sectors going through anti-involution, prices being increased for certain sectors, and we think that could contribute something like 2 to 3 percentage points to the EPS line. So that gives us earnings growth of 9%. And then on top of it, we've got 1% buyback, which is a current running yield for buyback for Chinese equities. So altogether, 10% EPS growth and valuation of 4 or 5%, giving us 15% upside for Chinese equities.
Where is China when you look at the 2026 global equity market outlook?
As a house, we are positive on Chinese equities and US equities. So we've got this tech trade. So we believe AI is going to be the dominant thing still for global equities. And the best ways to play that is going to be through US and China.
Your 2026 outlook also notes that favorable factors like AI advancement and policy support may continue, but their driving force could weaken. Does that imply a more selective and stock pickers market in the year ahead?
I do feel that long-term money are going into the AI sectors, but to be fair, the long-term money hasn't gone to Asian market just yet. And that also comes from my other point, is that offshore money, particularly long-only money, they haven't had the bandwidth. And so we do need the teams to build up, and then I think the foreign capitals will flow. The long-term money will come into some of these AI names. But I think the interest is there. But the question about monetizing AI, I think it's a global question, right? I think if you talk to US investors, global investors, the same question hangs over US AI names? Can the mass investment they're making, we're talking about 500 billion of US per annum into AI, can companies monetize off it? So I think it's a global question for everyone. But the one thing I would comment for China is that a lot of the investment in the US also had to do with the lack of infrastructure, energy shortage, data centers. Whereas for China, we'll have less of a problem. So we're actually at an advantage in respect of that. But obviously, chips, that's a bit of a shortcoming for us.
How would you evaluate the mainland stock market performance since the start of 2026?
It's something that we've been hoping for, expecting to see, and it's really coming through. And we think there's going to be more coming through. Is retail participation, this animal spirit coming back in Chinese equities? Because let's face it, interest rates in China are very low. Retail deposits are generating only 1% return. Government bond yields 1.8, not even 2%. So I think the reason why a lot of retail investors haven't gone back into the equity market is they felt scared, they didn't feel like there's money making. But now we've had 2 years of consistent performance in the equity market. So I do think that money generation effect will encourage more retail investors to come back into the equity market, particularly on the A share. Also, we should expect insurance companies with the new premium allocation from last year's premium sales, it should come through into the equity market. And then we also expect foreign institutional investors starting to allocate towards China, and that decision is usually made at the beginning of the year. So we think first half is a lot of flows into the equity market, propelling the market forward.
What is the biggest concern that global institutional investors currently have about China equities? How do you address it?
One thing that's attracted a lot of foreign investors to come back into China in the first place is that previously a lot of investors worried about the systemic risks associated with the property downturn. I think that's being removed. But the next leg, I think we do need the consumers, companies or consumer in general, consumption in general in China start to come back in a big way. I think that will attract foreign capital. And the other part of the investor base, I think, is this innovation in China. I think it's very clear Chinese companies are doing well globally. We are innovating. Our products are better than the peers. If you want to invest in the future, if you want to invest in innovation, the Chinese equity market is definitely a good way to play that. I think the money-making effects are there. I think definitely investors see the diversification that Chinese equity market brings to their portfolio. And certainly when I speak to investors, I can see investors' interest growing, or foreign investors' interest growing in Chinese equities, particularly long investors, and I think that money will flow and eventually will come back into Asia, just like what we're seeing prior to 2024.
You've added exposure to going abroad concept stocks like some industrials and materials names. Is that a tactical bet on a global cyclical recovery, or it's a strategic shift towards Chinese firms with global competitiveness?
Last year we didn't have some of the going global names because we were worried about tariffs. But it turned out these companies, these going global companies, continue to be very resilient. These Chinese companies are doing well, not because they're cheap, because in innovation their products are good enough to compete globally. For us, I think it's a structural trend that's going to continue. Yes, there will be uncertainties around geopolitics and tariffs, but I think that structural trend is going to continue. And one thing what we found is some of these companies with high overseas exposure is their revenue growth has consistently outperformed the broader market, right? And they're outperforming because their products are good enough and they are gaining share overseas. So I think that trend will continue. And also what we've observed recently, in 2025, their earnings growth have actually picked up. They've accelerated. Some momentums with these stocks, and that's why we've added these as one of our thematic themes for this year.
UBS has constantly favored internet, hardware tech, and brokers. With valuations having risen, what do you think will be the next catalyst for these sectors, and where do you see the most durable earnings growth?
For now, I think we still very much like the hardware tech names. And within those, very much the semiconductor equipment names, because I think you will have sector rotations, but the big trend, the structural trend, is semiconductor localization, and we think that will continue over the next 2 to 3 years. And I think to us that trend is unstoppable. On the application side, we still like the internet giants in China because I think they are the ones that will most likely monetize off the large language models, the AI innovations. For internet, for example, we've had actually pretty tough competition within food delivery. So to the extent there is some softening in competition in the sector, I think that's helpful. Within brokers, for example, it's actually, I feel brokers are very undervalued for China. If I look at the earnings growth for the broker sector, they're about 70-80% growth last year. If I look at their valuation, they're still around historical average, right? Nowhere near the past peaks we have seen. So to me, it's a cost-effective way to get into this, beta rally or this, very strong rally bull market that we're seeing in the Chinese equity market.
You removed high dividend stocks from the preferential list as yields compressed. In what market environment would defensive yield strategies become attractive again?
We've had this barbell strategy throughout last year, and I think the year before that. And we've taken off high dividend names for a couple of reasons. One is that you find that we're not expecting a lot of interest rate reductions this year, and you'll find that typically high dividend names, or it's just a proxy or a substitute for a bond asset. So to the extent we don't get the same kind of rate reduction, I think it makes the high dividend names less appealing. Second thing is actually because the high dividend names have done so well, and for me, we actually done a historical analysis, and we found that the bar for high dividend names to perform well is about 6% dividend yield. And beginning of last year, we can still find stocks, particularly financial stocks, that give me 6% yield, right? Now, at the beginning of this year, we couldn't find any. Not a single financial stock give me 6% yield. So for lack of stocks to invest in, I think that's another reason that suggests that maybe they'll take a breather this year. And obviously we are positive on the equity market, and I think in a positive equity market environment, the growth names will outperform the defensive names.
Looking beyond 2026, what structural or demographic trend in China is currently underappreciated in China that could define the next investment decade?
If we're talking about the next decade, I suspect it will be healthcare, to be really fair. The population is definitely aging, and I think there's definite need for better healthcare services in China, and that need will only grow. And on top of it, you have seen biotech companies doing well last year, and I think we are also seeing innovations within the biotech companies, allowing them to compete globally. I think it would take time for some of the long-term money to build up the expertise to look at Chinese equities. And I think that when that comes, I think you will see a consistent flow of funds to support the healthcare market.
Mr. Wang, thanks for joining us on Shanghai Eye.
Great, thank you.